Good afternoon and happy Sunday.
Good afternoon.
How are you today? Hope you enjoyed today's service.
Yes, thank God.
I'm good. So where are we? And where are we heading to? Hmm? Where are we? And where are we heading to? Oh yeah, where did we stop?
So the question on the extended trial balance.
Balance. So let's move down to chapter 6. I think we've done 1 to 5. So this chapter 6, I'm not wasting time. Okay. I'll just explain some things, then we solve question on it. Are we together? So today we want to look at, I think we need to solve a question on this thing. Um, but we'll do it during the week. Let's just move as fast as possible because we don't have time. So we are moving to chapter 6. I think we are done with chapter 5. What's in chapter 5? Okay, we are done with chapter 5. We only need to solve question on um, both errors that affect the balance and the error that d- don't affect balance. It's fine. So chapter 6, we are moving to property, plant, and equipment. Now, like I said, um we have two types of assets. We have the current assets and the non-current assets. Non-current assets can be divided into two. We have tangible assets and intangible assets. So tangible assets are the assets we can see with our physical eye, we can touch, we can we can also feel them. They have physical existence. Are we together? Are we together? Oh, but when it comes to um when it comes to intangible, they don't have physical existence, but they result in an inflow of what economic resources because of the result of because we are able to what get inflow of economic resources, so we can actually see them as what as an asset. Are we together? Hello. Right? Hello. We can actually see them as what as an asset. So now let's quickly move down to what we have in property, plant, and equipment. We want to account for non-current assets. So without wasting much of our time, Non-current assets is being guided by IAS 16, which is property, plant, and equipment, which is the standard that guide us on how to itemize non-current assets, which is being classified as property, plant, and equipment. Are we together? And we said an asset can be defined as a resource controlled by an entity as a result of past events and from which future economic benefits are expected to flow to the entity. So we see an asset to be an economic resources which arises which arise as a result of the past events and from which it is expected that there will be a flow of or inflow, there will be a flow of economic resources. And which kind of flow? It must be what? An inflow. Are we together? Are we together? Are we together? Now, how do we know that?
Yes.
And how do we recognize an asset? Number one is that these assets, based on the above the definition we've stated, we must know that an asset must be a resource. Are we together? It must be a resource. Number two is that it must be owned and controlled by an entity. That is, there must be a control over the what? Over the asset by the person that owns it. Then the next thing is that another thing is that it must be from past events, something we've actually done before. Then the last one is that resources, economic benefits are expected to be derived by the what? By the asset by the entity from the what? From the assets. That is, we are expecting future what? Economic benefits. Are we together? Like I said, we have two types of assets. We have the current assets. Now, according to you are the one controlling my mouse, you are now controlling it. Maybe you should bring it home. Or another thing is, let me remove the Bluetooth here. Oh, yeah. Well, consent. So, like I said, now according to IES one, which is based on presentation of financial statement, current assets are cash, receivables, prepaid expenses, and the inventory. And we see them as uh, and they are assets. We see them as as an asset that we are likely to realized that are likely to be realized, sold, or consumed in an entity's normal operating cycle, or within 12 months. That is, our expectation is that this asset must be used within 12 months within the normal operating cycle of the entity, or within 12 months after the end of the what? Reporting period. Are we together? Are we together? Oh, hope you are getting it. Then we also have non-current assets. Non-current assets are assets that when were not bought purposely for us to sell them, but we use them for a long time. their useful life is more than what? Is more than 1 year. Are we together? Then we can classify that one into tangible, like I said, we can classify it into tangible non-current assets and intangible non-current assets. Now, tangible non-current assets are assets that have material and physical what? Existence. We can see them, and they include land and buildings, plant and equipment, motor vehicle, furnitures and fittings, machineries and others. Then we have intangible non-current assets. They have no physical existence or material existence and cannot be touched, but they provide what? Expected future benefits. Like let's take for instance reputation. Through reputation, people are likely to what? To buy the products, the company's what? Products. Yes and yes and yes. Hello.
Yes.
So they don't have what? Physical what? Physical existence. Are we together? So they don't have what? Physical existence. So what are the example of these intangible assets? Number one is goodwill. The next one is copyright. Like that. Copyrights, patent rights, and others. So those are the examples of what? You cannot see goodwill, the goodwill of you cannot feel you cannot see goodwill, but once the company is able to what? To buy goods in once the company is experiencing um constant this thing patronage because of its name, then you know that the company is what? The company is making money. There is what? Existence of goodwill. Then how do we determine the cost of non-current assets? Almost every business entity of an entity, almost every business entity of any size or activities uses assets durable, of a durable nature for its operation. Such assets are not acquired for resale, but they are being used to increase the earning capacity or productivity of the what? Of the organization. Are we together? We buy them because we need them. We need it for the sake of what? Earning, increment in what? In the earning capacity or productivity of the what? Of the entity. Are we together? Are we together? So now, how do we measure? How do we measure what? Non-current assets. At the date of acquisition, property, plant, and equipment are recorded at their historical what? Historical cost. So we measure our non-current assets based on their historical cost. That is the cost at which they are being what? Purchased when they are being acquired. Are we together? Or constructed? Are we getting it? Now, what do we mean by cost? Cost refers to the amount of cash or cash equivalent that was paid or the fair value of other consideration given to acquire an asset at the time of its what? Acquisition or construction rather. So we see cost to be the amount of cash we pay or cash equivalent we pay. Likewise, the fair value of other consideration given for us to what? For us to acquire an asset at the date of its what? Construction. Business entities sometimes construct by themselves using available materials and manpower. Assets such as building, plant and equipment, furniture, fixtures and fittings. This can be done in order to save cost and likewise to meet preferred specification or simply because they wish to make use of idle what? Capacity. Now, what do we mean by fair value? Fair value is the price to be received in an orderly what? Transaction. Is the price we actually received in an orderly transaction between participants at the what? Measurement date. So we see fair value to be the price to be received or given given in an orderly transaction between what? Market participants at the measurable measurement date. Now, transaction in which two or more unrelated parties agree to do business. So it must be at what? Arm's length for us to measure um the fair value of our assets. Now, what are the components of cost? Acquisition cost. Number one is we will be looking at the purchase price plus plus import duty and non-recurring levy. That is something we cannot get back, less any trade discounts and rebates. So for us to determine the cost we actually incurred in acquiring our assets, we are looking at the purchase price of the assets. If the asset is not being purchased here in Nigeria, is from another country, where we incorporate import cost and other non-recurring levy. That is, those levy we know that in one way or the other we can't get them back. Once we pay them to the government, they cannot be called back. Are we together? Are we together? Then we also look at the directly attributable cost of bringing the asset to its location and condition. We look at the cost we incur in bringing the asset to its location and what? Condition. And working condition for the purpose the management intended to use the asset. So we look at other costs like other costs that surrounds the purchasing of the asset, the acquisition of the asset. Now, what are the other costs we will be looking at? Like installation cost, installation or construction cost, then cost of preparing the site for construction, the cost we actually we incur to prepare the site for the asset construction, then installation and assembly expense, cost of testing the asset on completion, and the relevant professional charges. So those are the costs we will be looking at as directly attributable what cost of bringing out the asset to its what to its condition. So now let's look at this example. So here we have Floor Works Nigeria Limited, orders a machine from Nigerian tools manufacturer. This this company is from Sierra Leone and he made an order from a Nigeria company. I wait to get this one for me. I wait to get together. I wait together.
Yes.
Okay. So those are the directly attributable cost of bringing the asset. So now let's look at this question. Floorworks a Sierra Leone company orders a machine from a Nigerian tools manufacturer at an invoice price of 100 million Lee. The payment will be made in 48 monthly installments of 2005, 2.5 Lee, including 20 million interest charges. Other relevant costs include the value added tax, the freight charges, installation, and other up costs. Then we have three discounts given. So so we are now being asked, what is the total cost of this asset? We want to determine the cost of the asset. Then the first one I told us that for us to determine the cost of an asset, what is the first thing we need to consider? That should come to your mind if they ask you to determine the cost of an asset. What is the first thing that will come to your mind? Hello, hello, hello. Are you there?
Yeah.
So what is the first thing that we need to consider if we are to determine the cost of an asset before other costs? What will be the
Type
first
of
thing
asset.
that will come when you want to determine the cost of an asset? What is the first thing that should come to your mind? What is the first thing that will come to your mind?
The type of assets.
Okay, type of asset is the first thing that will come to your mind when you tried. Well, the purchase price of the asset is what I think should come to your mind. Okay, how much are we getting? How much are we buying? The assets. Are we together? So the purchase price will be the first thing that needs to be considered. Then we are being told, based on what I've said before, trade discounts will be deducted. Are we together? So trade discounts will be deducted. Then we now add other what? Other other costs to what? To the assets. Are we together? Other cost of installation will be added, like the VAT, the trade discount, the VAT, the transportation charges, then installation. Cost of installation will also be what? Will also be recognized. Now, the interest charges of $20 million will also be recognized as an expense over the what? Over the 48 months. So the interest charge, it is because the asset is now in use. Are we together? Are we together? I'm coming, please. I'm sorry for the break in transmission. So now we are considering the invoice price. One, we need to deduct trade discounts. Then before we now we have to add VAT, transportation charges, the cost of installation as part of what? Now the interest charge will be expensed in our POL. So we expense that and we write it off over the what? Over the period, over 48 months. Are we together? Now, element of cost of different types of assets. We are looking at what are the element of each cost of what? An asset. Let's pick from land. What are the costs that we need to that will be considered when we want to record land in our what? Financial statements. Are you there? Hello?
Yeah.
Okay. So what are the costs we are looking at? One, when land is purchased, certain incidental costs are generally incurred. Number one is you need to look at the purchase price of your land. Are we together? Then you also need to consider now other incidental costs. Then you consider other incidental what? Incidental cost of the purchase of the land, and which include commission to real estate brokers. The real estate brokers that assist you in getting the what? In getting the assets. That's the agent. Then clearing and grading then the next thing is legal fees for examining and ensuring the title of the what? Title and fees for what? For surveying. So that one will also be considered. The legal fee you pay when you want to what? When you want to acquire the assets. Then then you need to also consider the professional fee you pay to the consultant, the consultancy fee you pay to your consultant. Are we together? Are we together? Are we together? So without wasting much of our time, so another costs that are directly to the what? Acquisition of assets before the what? Before the usage of the assets. So those are the costs that will be considered. Now, also you also need to consider any local improvement so those are the costs that will be looked at when you want to determine the cost to be written in your profit or loss. Are we together? Then we now move to the cost of a building. Now, when it comes to the cost of building, the cost of building includes all expenditure related directly to the acquisition of a building. And what are the costs incurred? What are the costs related directly? We will be looking at the cost of the material, the labor, overhead cost, and the cost of bringing the what? Bringing the construction, professional fees. Okay. And the cost of bringing the asset to its what? To its location or for its intended what? Use. Are we together? Now also we'll be looking at the subsequent the cost of equipment. When it comes to cost of equipment, include the delivery of our equipment to customer. Are we together? Now, the term equipment in an accounting includes delivery equipment. So now let's consider. Okay, we've talked of. Now, when it comes to cost of equipment, the term equipment in accounting includes delivery equipment, office equipment, machinery, furniture and fittings, factory equipment, and similar assets. So we are looking at the cost of um, the cost of equipment. You know, hello, hello,
I'm
are you
here.
there? Okay. Now we've talked about now for an equipment, what are those costs that should be included as part of our costs of equipment? We are looking at the purchase price of our equipment. That should be the first thing. The freight price and handling charges incurred, insurance on the equipment while in transit and cost of inclusion. Are we together? Are we together? Oh. Now let's quickly look at capital expenditure and revenue expenditure. Are we together? So we want to look at the difference between capital expenditure and what revenue expenditure. What do we mean by revenue expenditure? Revenue expenditure may be defined as the cost of acquiring non-current assets for use in what in an asset. So now when it comes to capital expenditure is the cost of we acquiring an asset for use is the so those are the cost of uh, So what are the examples of? Now, capital expenditure include costs that are incur in adding value to existing non-current assets. So for us to know that an expenditure is of capital in nature, we must see that we are the asset in nature to the existing non-current assets in order to improve the earning capacity and also prolong their lives for more than what one accounting period. That is, the main motive is that this asset we are saying is able to improve the earning capacity of the entity and also improve the what life of life for more than what one accounting year. Are we together? So where are we? I'm coming, please. Now let's look at the examples of capital expenditure. You can find it in your question. You'll be asked, what are the examples of capital expenditure? Number one is purchase price of non-current assets. You have to consider your purchase price of non-current assets. Another one is extension or any improvement of permanent nature made to for any structure. Are we together? So now purchase price of non-current assets, which include the purchase price of motor vehicle, building, furniture and fittings, then plant and equipment. Then extension or any improvement of a permanent nature. Extension or any improvement of a permanent nature to any of these assets. That's capital expenditure. Are we together? Then the next one is the cost incurred in bringing any non-current asset to its present location. The cost we incur in bringing our asset to its present what location. So another one is the legal fees of acquiring land or building. That's another type. The cost incurred in bringing any non-current asset to its location must also be considered. Then any other cost that must be incurred in getting the non-current assets ready its for a while. Are we together? Are we together? Hello? Are we together? Oh,
Yes, okay.
good. So now let's move on to the next topic. Hello? Are you there? Then any other cost that will be incurred in bringing the asset to its location or condition should be recognized. Now, let's look at revenue expenditure. Revenue expenditure, on the other hand, is any cost in which the earning potential is exhausted within one accounting period. That is, it is an item in our financial statement in which any capacity is being exhausted with within one accounting period. We are able to derive the actual payment to be made to um, the admin. So now let's look at revenue expenditure. Revenue expenditure, on the other hand, is any cost in which its po ten tial is exhausted within one accounting period. That is, the earning capacity. Are we together? Are we together? Oh. Now, revenue expenditure is any cost in which the earning po ten tial is exhausted within one accounting period. Such expenditure are not to increase or improve the value of non-current assets. So we now have features of revenue expenditure. What are the features of revenue expenditure? Now, before then, revenue expenditure, on the other hand, is any cost in which any po ten tial is exhausted within one accounting period. It is expected that the cost we incur on being incurred on this asset is being exhausted within 1 year. So such expenditures are not made to increase or reduce the fair value of non-current assets either, which are being made for number one, po ten tial. We use it for the sake of po ten tial. We also use it for day-to-day running of the business. Are we together? That's computer. Then let's look at the example. Number one, the cost incurred in acquiring the inventories for sale. That is the cost we actually incur for us to bring the for us to incur such expenses. Then another one is cost cost of repairing any non-current asset. When we incur any cost of repair. Are we together? So any cost of repair will also be seen as a revenue expenditure. We also have discount allowed on credit sales. When we buy on credit and we are being given discount allowed, then you have to consider it. Examples in connection with rent, insurance, telephone and electricity, which are directly to what? To that asset. Okay, revenue expenditure. Then staff salaries and emolument. Those are the kind of capital expenditure we have. Then what are the difference between capital and revenue expenditure? Now, without wasting much of our time, let's look at depreciation. Then let's quickly look at depreciation. Depreciation is actually the wear and tear of your non-current assets, which are tangible assets. Are we together? Are we together? Oh? Are we together? Hello?
Yeah.
Okay. Now, now, the process of recognizing loss in the value of non-current assets as a result of using such assets is being called depreciation. For us to know the definition of depreciation, we see it as the loss, the process of recognizing loss in the value of our non-current assets as a result of the asset being called what? Depreciation. Now, IAS 16 defines depreciation and some other equivalents and some concepts relevant to depreciation. So, when it comes to IFRS 1, so we know how the treatment of how a treatment will be what? How to record our depreciation. Now, without wasting much of our time. Now, what do we mean by depreciation? Depreciation is the systematic allocation of the depreciable amount of an asset to its useful life. When it comes to depreciation, is when we allocate our depreciation as regards the systematic allocation of our what? Depreciable amount. And what's depreciable amount? Depreciable amount is actually the cost of our assets minus um minus residual value. Are we together? Now let's look at this all this definition. Now, depreciable amount is the cost of an asset or its revalued amount in case where a current asset is revalued, less residual value. So for us to determine the cost of our asset, we are looking at the sales of the sales. Okay, we are looking at the cost of the asset. Then we will now less the what? We have to now less the residual value. Are we together? Now, what do we mean by residual value? Residual value is the expected disposal value of the what? Of our assets at the end of its what? Useful life. That is, it is the money to be incurred at the end of the of useful life by the what? By the entity. Now, what do we mean by useful life? Useful life is the period the in which asset is expected to be available for use by the entity. That is when a particular value is expected at the end of the what? At the end of the accounting period. Now, then we move from there. Then what are those things that can lead to depreciation? Now we have some things that can lead us to depreciation. One is physical deterioration. There's a physical contact. Now, this is where a fall in value of an asset is due to wear and tear as a result of its constant use. Now, constant use Are we together? So one the first thing we need to consider when it comes to those things that cause our depreciation. Number one, we look at the physical deterioration. That is, we look at if the asset is actually in what? In good condition. Are we together? Then the next one is obsolescence. Now let's quickly move on to the causes of depreciation. Like I said, we have physical deterioration. This is where the fall in value of an asset is due to wear and tear as a result of constant usage. That is when you use your assets often, then physical deterioration will set in. Then we also have obsolescence. Now, what do we mean by obsolescence? This is where an asset of so move. Then what are the ways by which we can actually get the value of of our assets at the end of each financial year? What are those things we'll be looking at? Number one, there are several methods of calculating depreciation. We have several methods of recalculating our of calculating depreciation. One is to calculate. So hello, hello, are you there?
I'm here.
Hello, okay. Now like I said, we have methods of calculating our annual depreciation. We have several methods of we getting the value of our annual depreciation. The first one is straight line method or fixed installment method or equal installment what method. So straight straight line method is being used for us to determine the real value of of our assets. Then the next one is reducing balance method. We also have reducing balance method. Then after them, some of the year digits. We have some of the year digits. Then the next one is are we together? Are we together? Oh? We have some of the year digits. We have units of output method, evaluation method, machine hour method, then depletion method. Are we together? So those are the ways by which we can actually determine the objects. for us to determine the value of our what? Depreciation, annual depreciation. Then the next one we will now be looking at now is hello. So now, what are those things we need to look at when it comes to coming these things? Please coming. We've talked of the covenant of component of acquisition costs. Okay. So we've talked of factor and revenue expenditure. So let's quickly move on to depreciation. Like I said, depreciation is the what? We so we are looking at so now let's quickly look at how we can actually determine the value of our assets. Now I've said something on the causes of depreciation. Number one, physical deterioration, obsolescence, inadequacy. That's another one. Depletion is actually based on mineral resources. Then find time what factor when uh, when the stuff is ready. So we now have methods of depreciation. What are the methods of we preparing our depreciation? We have straight line. We have a straight line method, reducing balance, some of the year digits method, unit to output method, revelation method, revaluation method, machine hour method, then depletion method. Now, coming to straight line method, this is the formula for straight line method. Then this straight line method also has another what? Another useful. Are we together? So straight line method is the most widely used method of computing depreciation charge or financial statement purposes. So it's the art by which we want to accept before we deliver the what we post depreciation charge for the year. Are we together? Are we together? Oh, now this is the formula. The formula is actually the cost of the asset minus scrap value, everything divided by the number of units used. So now annual depreciation using straight line method is just the cost of our asset minus salvage value or scrap value, everything divided by the useful life of the asset. I think I've written something like that before. Now, they gave us an example. They said on 1st January 2022, the Age Limited purchased a motor vehicle for $25. So now we have here, sorry for the break in transmission. We have here on 1st January 2022, I Limited purchased a motorbike for 250 Lee, 250,000, 250 million. The motor vehicle has an estimated useful life of 5 years with a salvage value of 5 million. You are required to calculate the depreciation charge and depreciation method. So now, can you read the question from your side? Hello, hello, hello.
On January 1st, 2022, Hyde Limited purchased the motor vehicle for 250 million. The motor vehicle has an estimated useful life of 5 years with
Uh-huh. With a salvage value of L 5 million. You are required to
spreading
calculate.
with a salvage value of 5 million. We are required to
Okay.
calculate the depreciation charge and accumulated depreciation for each of the years and show the net book value as at the end of 2026 accounting period
Okay.
using the straight line method.
So how much is the purchase price of the assets? Are we together? So
250 million.
that's 250 million. Now, we said the annual depreciation is the cost of the purchase cost on the asset um minus salvage value. When you see salvage value or residual value, it is the same thing. Are we together? So we are required to calculate the depreciation charge and accumulated depreciation for the period. I don't want us to. I'm coming. So here we are. So we say annual depre- So now when it comes to annual depreciation, we have the cost on the assets, cost of the assets The purchase price of, okay, the cost of the assets minus cost of the assets cost of the assets minus cost of the assets. So cost of the asset, that's um minus salvage value then everything divided by useful life of the assets. Are you there? So now, based on the example, so what's the purchase price of the assets? How much is the purchase price of the assets? Hello? How much is the purchase price of the asset? Oh, so we have 250 million Lee. Hmm? So we have to, so we have 8, 20. So minus 50 million Lee. Then everything divided by how many years is the asset? 5 years, Abby. So we have, so 5 years. So what's the value? So everything divided by, so what is our answer? So pick your calculator and this 5,000 for your information, not 50. Oh. Are we together? So what is your answer? Hello?
49 million.
So we have 49 million. That is our what? Annual depreciation. So we've gotten 490 million. So the next thing is to what? Is to prepare our accounts. So for each of the year. So how do we go about it? So we'll bring it here. So we'll say depreciation. Are we together? So anytime we want to record depreciation, we are recording it as an expense. Are we together? So we say year one. Year one. Year one. So we have accumulated depreciation because this thing is going to accumulate depreciation. Accum- So year one. So since we have, so we just say cash or bank. So this one is going to accumulated depreciation. How much? How much is it? That's 49. That's 49 year. So say 49 times 3. So moving forward. So at the end of the year one, which is 31st. So we have, what's the this thing? Okay, this is what we are being asked to do. But it's fine, no method, we can use any of the method. Are we together? So this is what you are being asked to do. So 2022, 2023, 2024, 2025, 2020. But let's do the one we are doing first. Let's finish. So year one, 31st, which is the last day. Then we say P or L. P slash L, same amount. So year two. Year two. We also transfer this to accumulated depreciation. Then the same amount. Then so we have that. This one will be for year two. Are you getting it? So the same thing for year three up to 5. So for year three, year four, then year 5. So that's all. We are done with the first listing, depreciation. Then accumulated depreciation account. So the next thing now is all this one, you pick one after the other. Year 1. So we'll bring it from depreciation accounts. How much? 49. Are you getting it? So we have, because this accumulated depreciation account is actually is actually um a we need it for us to record it in our statement of financial position. It is needed for the sake of what? Our statement of financial position. Are we together? So what do? We say the end of the year 1, then we'll call it balance carried down. Are we together? The same thing. So close our accounts. Do you understand? Then year 2. So year 2, beginning of year 2, you know the way we do our this thing, our um the way we do our ledger. So your balance, now have your balance brought forward or balance brought down. Anyone to be 49, 49. So year 2, the charge for the year from in this place. So we have depreciation. How much? The same value. Are we together? So I'm taking you the ledger form. Do you understand? So I just want to take you the ledger form. You add it together. Hmm. Then you come here. So we now have 98. Are you getting it? Are you getting it? Oh, So our answer
Yes.
will be to move. So your balance carry down when it comes to this place, year three, it will now be what? It will be what? When we get to the beginning of year three, it will be what? It will be what? Oh yeah. What will you put here as your narration? We have balance brought down. You know this now. Eh? Oh yeah. The charge for the year. Then depreciation for the year. Abi? So the same 49. We are bringing this from, so we are together. So as usual, this year two. Year three. I want today. Are we together? So as usual, we are together. Abi? What should mean no. Then as usual, year four. So I am taking you the ledger form. If you are being asked to prepare the ledger form, this is how it is. So 140, Abi. Then this will be our year four. So you add, we are adding. I hope you are getting it. Are you getting it?
Yes.
Hello? Okay. So, and you know how to prepare the ledger in your book. I'm only using this thing, Excel. I will send you the solution, sha. I will send you so that you will understand better. Year four. So you do that of year five. Are you getting it? So that's all. Then, if you are being asked to get accumulated depreciation, you can use the method you have in your this thing. You have in your um pack. You can use this method. As you can see, 2022, 2023, 2024, 2025, 2026. We have the carrying amount. So at the beginning of 2022, we have this to be the cost at the start, then depreciation for the year. Accumulated depreciation is this, then we have this. So at the end of the period, we have the residual value, which is 5 million Lee. Are we together? So that's how that one works. Then reducing balance method. Using this method of depreciation, the book value of non-current assets at the beginning of the year is multiplied by a fixed percentage to determine the depreciation for the year. So for the reducing balance method, every um, balance you have at the book value of non-current asset, that is the carrying amount at the beginning of the year, you multiply it by a fixed percentage. Like now, so we will use this as the example we have. So now let's use this method. Okay. So they said on 1st January 2022, John K. Limited purchased a plant and we are being given 20% per annum. We are required to prepare our carrying amount at the end of the year using reducing balance method. Then also sometimes they might give us percentage when it comes to straight line method. So you don't need to bother yourself. Let's assume for this question, they did not give us the estimated useful life. They will give you the estimated useful life. Then they will also give you residual value. Then you have to calculate depreciable amounts. Are we together? Then you now apply your percentage. Do you understand?
Yes.
So you apply your percentage. Like now, they gave us 250 million leave, and then they just say the our depreciation rate is 20%. So you know that when we are sometimes they may not give you the actual percentage. So if they say 20%, so your own is to just come here and tell them that 20% will give you, for us to know the number of years, just divide your 20 by 100. Just say 100 divided by 20. So you now multiply it by number of years, by years, to get the actual year. Are we together? Are we together? To get the actual year, you just tell them, okay, 100 divided by 20. Then that, you know, that one will give you 5. You know that you are calculating based on what? 5 years. Are we together? Then your asset account also is very, very important. So the only thing you just need is doing the carrying over of your what? Of your cost. So like now, let's take for example this. I'll just change some things here. So you don't need to stress yourself using the actual, what's the asset? What is the asset? Oh, motor vehicle, abi? So we are being told motor vehicle, motor vehicle. You just say motor vehicle. So our motor vehicle, then you don't need to stress yourself. How they will tell you the method of purchasing your what? Your motor vehicle. The way is it that the motor vehicle is being gotten by paying check, or we actually pay what? Cash. So you don't need to bother yourself. Just tell them cash or bank. Are we together? Cash slash bank. So I do it over like that. Then how much? 250. Then you don't need to stress yourself. Just repetition. Hope you understand. So that's all. Then the balance carry down for everything. This will be balance brought down. That's all. Hope you understand. Do you understand? So that's
Yes.
for if you are being asked to prepare your ledger. But if they did not ask you to prepare your ledger, you use this method. So let's quickly use this method in solving our question. So using reducing balance method, they gave us 20% to be um, our depreciation rate. So what do we need next? What we need next is to uh, use this format. So we have the year, carrying amount, depreciation rate, then depreciation for the year, accumulated depreciation then at the end of the year. So that those are the headings we need. So we come here, reducing balance method, using balance method. So we have a year, don't forget your year, the carrying amount at the beginning, carrying amounts beginning, then we have depreciation rates. Then depreciation, depreciation value. We have a depreciation value, then accumulated depreciation, accumulated depreciation, accumulated dep- then the last one is now carrying amount at the end of the year. Are we together? So 2022, so we know that we will have a 250, 1, 2, 3, 1, 2, 3. Abi, then depreciation rate is just 20%. So what's 20% of this? What's 20%? 20% of this will just give you this. Abi, minus it. You minus. So that will be equal. Oh yeah, what's the accumulated depreciation? Your accumulated depreciation will just be also be 50 million. Are we together? Then accumulated depreciation carrying amount at the end of the period will now be the it will now be your carrying amount at the beginning minus your accumulated depreciation. Do you understand?
Yes.
Hello? It will be carrying amount minus your what? Accumulated depreciation, which is this. So what is our value at the end of the period?
200.
So we have 200. So 2023. So this will be our new balance. Abi, so apply 20% on it. What is your value? What is your value?
40 million.
How much? How much? Oh,
40 million.
40 million. Then accumulated depreciation will now be addition of this and this. Are we together? Addition of your current depreciation for the year and your accumulated depreciation. So will be for the year two, which is 2023. So that's how much? That is how much. Oh. How
90
much do
million.
we have? Huh? How much do we have like that? What is our value?
90.
Okay. So minus it. What do we have? Which is this minus this. So what do we have?
160.
What is our value? Eh? Oh yeah, now what is our value?
160.
Is how much? You see those things
Once,
these two
yeah, you know,
at the beginning and accumulated depreciation is what I'm saying. Can you see? Minus this. What do we have? I hope you see where I put where we have a blue this thing. So what do we have? What is the value?
110.
110. So you now carry your 110 to year Abi. This 2024. So 20% or so as usual. So what is 20% of one thing? 20% of one thing. Oh yeah, press your calculator. Chap chap. What is 20% of your one thing? My phone is going to do this. Please. Phone is
22
going to.
million.
Okay. Now your accumulated depreciation will be hello ma. I call ma. Ma? To bless God ma. Thank God ma. Okay ma. No problem ma. So add it together. This we have this plus this. What is your value? What is your value? What is your value? 90 million, 90 plus 22. What do you have? Oh yeah, what is the value? 90 plus 22. Hello?
112.
Okay. 112. Now this one minus 110 minus 112 minus no. It's not possible. Okay, this is what they did. Okay, this is how it works. Sorry, I'm the one that made mistake. We can't it can't work like that. This is it. You deduct your depreciation for the year from this thing to get the carrying amount at the end of the period, which is this minus this. Then likewise this minus your depreciation for the period in order to get your carrying amount equal we have, so this will be your carrying amount at the beginning of the period. What we just need here is the carrying amount. Are we together? So equal 160 minus 32. Are we together? 2025. This. Are you getting it? Are you getting it? Hello? So what's 20% of 128? What's 20% of 128? Can I explain again? Hello? Hello? Hello, are you there? Hello? Can you unmute
I'm
your
here.
mic? Okay. Let me explain what's take place between here. We only have interest um in the carrying amount. So it is now the carrying amount at the end of the period will just be the difference of the the difference between the depreciation rate, the depreciation value for the year minus your depreciation, the carrying amount. Are we together? So like this 250, 250 minus 50,000, we have 200. So we carry this 200 to the following year. We apply 20% on it, giving us 40. Now, when we have 40, the next thing we need to do is minus the 40,000 naira, not the 90,000 naira. Are we together? The only thing we need here is to calculate our accumulated depreciation. That's all. So accumulated depreciation will just be on its own. So 200 minus 40, we have 160. Are we together? The next thing, you carry your 160 to the following year. You apply 20%, giving you 32 million. Then now minus your 32 million from 160. It will give you the balance at the end of the period. Like that, till you get to year 5. Now this is the value for year 5 at the end of the period. Hope you get that.
Yes.
So for us to now get our percentage, for us to know the depreciation rate for reducing balance method, this is the formula we use. That is 1 minus n root residual value divided by what? Cost of the assets. So we will be able to what? Determine our depreciation rate for the period. And as you can see, that's the same thing that was what? That's been applied here. That is 1 minus n root r r, which is residual value divided by c, for us to determine the depreciation rate. Are we together? So next, tomorrow when we meet, we talk on how to get depreciation rate. We apply this. I hope you understand. So here we come to the end of the class for the day. Thank you for joining. Then we'll move on tomorrow.
Thank you.
Take care.
Bye bye.
You're welcome.